What's good everyone, welcome back to another video on the YouTube channel, and this video I'm going to teach you guys about low probability conditions. So if you've been a follower of me for a while, you'll know I made a video about this over a year ago, and one of the concepts that I did teach was about an inside day candle range. And as you guys know, that one candle range has gotten popular as of recently, but I did already make a video about this, and I want you guys to know that anything that is introduced to trading is never new, it's always been taught before. So what I'm going to introduce you to now is known as an inside day range, and I did teach this over a year ago. So I'm going to teach you guys how to utilize one candle's range to know when to not trade and when to trade also. As I said before, I made this video over a year ago and the link to this is in the description. However, this is going to be an updated version, and I'm more than certain the other mentors out there that have been teaching about one candle's range, they're going to be taking notes from this video as well. And before we get into this video, I want to say a huge thank you for the support that you guys have been showing me on my recent video, which was a lecture, and I gave you guys an A to Z guide on how to trade. And from that video, a lot of you guys were saying that it changed your view on trading, which is amazing to hear. So if you guys would like to see another video like that, I'm more than happy to do another lecture, and we will do it live. So I'll do a live stream lecture like that again. If this is something that you guys would want, make sure to leave a like on this video and I will look to cover it in the coming week. I also have some exciting news coming out at the end of August. So if you guys want to be the first ones alerted about this news, make sure to join my Telegram group. There is a link to that in the description down below. Other than that, let's get into the video. Okay, so this is an interesting topic. I've been teaching about inside day candles and how to use one candle as a range for a long time, if you have been following me for over a year now. And this was one of the concepts that I introduced to know when trading is going to be low probability. Okay, so let's say this is a daily chart and this is how we closed. It doesn't matter if we close bullish or bearish because I'm going to show you guys both examples. So for this one, let's say we close bullish. And this is where we close to the upside. You are looking for price to be inside of a range. So this candle's highs and lows are important because you want to see none of them get taken out. So this is how we closed. So to know that the market's going to be low probability if we're bullish is if we close inside this candle's range. And as you guys can see, we have two daily closes which are inside of this candle's range. So what do we do right now? We can anticipate the market to seek and destroy. As we're doing this, what are we waiting for? We're waiting for, as we're bullish, for the sell side liquidity to be taken. So the sell side liquidity will be engineered below all of these lows. And usually you'll see it in forms of failure swings. So what are failure swings? So failure swings form like this, where price is trading higher and we fail to go below new lows. Once we make new lows, we trade higher and we eventually take out the failure swings. So these hold liquidity. However, you guys need to be careful and not identify them as SMT. If we have an SMT right here, the liquidity has already been taken below this low and it doesn't hold any liquidity anymore. However, let's say that the market was trading to the upside and we left these failure swings and there was no SMT, we trade to the upside, we are looking for it to break down and target these lows. So these hold liquidity and that's what we can anticipate right here. So we have sell side liquidity below this low and this low. Why? Because we failed to go below these lows, so we are creating new liquidity. Once we create new liquidity, what are we looking for? We're looking for a reversal from here and for price to take out all of the sell side liquidity. Once we take out the sell side liquidity, what happens here? Inside of here, this is where order pairing takes place. As we have the reversal here, this whole down move, this is where they're selling. And they're selling into the sell stops right here. We have sell stops below this low, and this low. Why these lows? Because they are failure swings, they hold liquidity, and we are inside of a range. So you guys don't want to trade this. You don't even want to trade the move to the downside. As we have a bullish bias, this comes in our favor. Okay, so why does order pairing take place here? Because this is where they'll offset their shorts as all the liquidity has been grabbed inside of the market, which was below all of these lows, and they'll offset their shorts for new longs, and market participants will go into the market selling below old lows. So they're selling in a discount and they are buying in a discount. And this is how order pairing works. And as you guys can see, we'll usually have a reversal once we take out this candle's low. So before this, we were just trading to the downside, but we were trading to the downside to absorb liquidity, which we did. So we take out the sell side liquidity. What are you guys waiting for? So you guys are not looking to buy straight away. Usually the first reversal that we have from the low is usually the false move, and they'll run the low again, trade higher. And this is where you'll see your bullish breakers form. This is where the breaker forms and price trades to the upside. And this is how the fractal will usually look. So this is how the fractal will look on the lower time frame. So this candle is the daily candle, this candle is the daily candle, and this candle is the daily candle. So this we can say is the hourly fractal. Price trades lower. So this was a bearish daily candle. It takes out this candle's low, and then we have a reversal. So this can be 2 daily candles, and this one trades to the upside. And what do we do now? We trade lower, we offer the first leg of distribution, then we trade higher again, offer the silver bullet, and the silver bullet trades above this candle's high. So before any of this was low probability conditions. So what made this low probability? That's because we were building up failure swings. So the market could have gone either way. As we had a bullish bias, we wanted the market to take out the sell side liquidity. Once it takes out the sell side liquidity, we're looking for a confirmation. And the confirmation usually is running out the sell side liquidity again. Price closes above the breaker, and we respect the low risk buy. Once we see the low risk buy being respected, you guys are looking to buy the first distribution and the silver bullet, and that will clear the what? That will clear the original consolidation, and we take out the candle's high. So this is how ranges form and how you guys can utilize a low probability condition when you are bullish. We're going to go over a bearish example, but I just want you guys to understand this. This is how one candle can just improve your whole trading. And before a lot of people say in my comments that this is a new concept, it's already been taught, it's being taught right now. I taught this over a year ago, and the video is still up on my channel if you guys want to check it out. It's low probability versus high probability conditions. And once we have an inside day range, which is this candle, there's no liquidity being taken. So we're building up failure swings. We trade lower, we take out the sell side liquidity. As we are still bullish, we are looking for the lows to be run out. We run the sell stops again. Price reverses, and what do? We don't chase price, we wait for a retracement. And where do we wait for a retracement? Into a logical area. It's either a breaker or it's down close candles which change the state of delivery. We trade into the down close candles, price trades higher again. Okay, so we traded higher, we are looking for a fair value gap to be respected, and this is the first distribution. And then we can utilize down close candles for the silver bullet, and then price clears the original consolidation. I'm going to go over a bearish example with you guys, then we're going to go over some chart examples as well. Okay, so we're going to go over a bearish example right now. So this is the candle. It can be either a green or a black candle, or green or a red candle. It doesn't really matter. As long as we have a bearish bias, we are utilizing this candle. So this is how we close, and we map out this candle's high and low. So all we do is wait for the market to build up liquidity, and we do inside of this candle's range. And what is it in forms of? It's usually in forms of failure swings. So this is where the market fails to take out the liquidity, and this is where the liquidity is built up. And this is how it usually looks on the daily chart. And then we just anticipate the market, as we are bearish, to take out these highs. Once we take out these highs, we are looking for a reversal. So inside of this fractal, before this green candle takes out the buy side liquidity, you are not trading, because this is all seek and destroy. And if you go onto the lower time frame, such as the 1 hour chart, this is all this market has been doing. So it's been seeking and destroying traders that are not aware of when not to trade. So as you guys can see, this is what the seek and destroy profile will look like on the hourly chart. And then we have price trading higher. Once we trade higher, what are you guys doing? You're not looking to sell straight away. Why not? Because usually the market runs the high again, takes out the early sellers, then we trade lower. Once we trade lower, you're looking to sell once we close below the down close candle, which change the state of delivery. And then once you see this fractal being respected, you're looking to sell utilizing the first and second distribution, and then it clears the other side of the candle's range. So usually this is what it'll look like on the hourly time frame. And you guys are not looking to sell straight away as the high's been taken, because usually that's the false run, and market will run it again, take out the new sellers, and then show the real move. However, you guys don't even need to sell this. You can use this as a confirmation to the first distribution, and preferably I would recommend you take the silver bullet, which is the second stage of distribution, and it will clear the candle's range. So I will be teaching one of my models which refers to this, where low probability conditions are helped to find high probability conditions, and I will be teaching it inside of my free Discord. So I'm going to launch that pretty soon. If you guys want to be on the waitlist for my free Discord, just comment Discord and I will send you an invite link where you can go onto the waitlist for my free Discord. So this is the source for the guys that watched it all the way up to here. So this is one candle's range. You are looking for the high to be taken. Once the high gets taken, you are looking to sell. You're not looking to do anything before the high gets taken. So as the high gets taken, you're looking for a reversal and you're not looking to sell straight away. Why? You're waiting for the market to confirm that it's going to be bearish. And what does that mean? That's when it changes the state of delivery. So it goes from a buy program, which was trading higher to take out the liquidity, and then we go into a sell program and then we trade lower. And you don't even need to take these 3 entries. These can be just confirmations for you to sell, which is the silver bullet right here. And this is the fastest and best entry there is in the market. Okay, so let's go over this again. You guys are looking for bullish failure swings, which form right here. So it's not always going to look like this, but if you can use failure swings to your advantage, this is how you can use them. As we are bearish, you're looking for the market to trade higher and trade above the failure swings. Once we trade above the failure swings, you're not looking to sell straight away. You're looking for another stop run. Price does the stop run, then we have a close below the up close candles right here. We have a change in the state of delivery, the low risk sell, which forms right here. This is respected, then we trade lower again. The first distribution is respected, and this is where you're selling short, and this is what your position will look like. You sell short here, your stop loss will go above the first distribution, and you will target the sell side liquidity. Or you can use the low risk sell as well if you want a larger stop loss, and you'll target the other end of the candle. So as many of you have already picked up, to identify high probability conditions, first you need to identify low probability conditions. And this is how one candle can show you guys low probability conditions. All you do is map out the candle's high and the candle's low. If we're trading inside of the candle, you do nothing. Why do we do nothing? Because we have a bearish bias and the market's not aligned with our bearish bias yet. So we can anticipate a seek and destroy profile intraday until we take out the buy side liquidity and we have a reversal to target the sell side liquidity that we are looking for. I know this might have gone over a lot of your guys' heads, so I'm going to make a flowchart on this which will be uploaded on my Twitter page that you can check out too. It will be completely free and it will be out in the coming week. So these are the templates that identify low probability conditions and how they can turn into high probability conditions. So as we've gone over all of that, let's go over a chart example right now. Okay, so let's go over a trade example that I did take live with my Discord. So this is the daily chart on the Nasdaq, and you guys can see we have this candle's range and we have a fair value gap right here. And you guys can see that we failed to go above this candle's high and this candle's low. So as we have a fair value gap right here, this is what we can look to target. So if the market trades higher, we can target this low. If the market trades lower, we have confidence to trade higher into this gap. So I was looking for the market to trade lower. Once we trade lower, we can target this gap. And as you guys can see, we trade higher. We failed to go above this candle's high. So this shows me that we have equal highs, and then we trade lower and we take out the sell side liquidity. And what is the sell side liquidity? It is a failure swing. So we fail to go below this low. So it becomes a failure swing and we make up the sell side liquidity right here. So let's move on to the 1 hour chart and see how this looks. Okay, so this is how the hourly fractal looks, and you guys can see what do we have below all of these lows. We have failure swings and they hold liquidity, price trades into them, and now we have a reversal. So what did I say? You don't buy straight away as we have the reversal higher. And you guys can see we've run out the low again. Okay, so as I said before, you guys are not looking to buy straight away. Why? Because the market likes to run out the liquidity from the early participants. So you can be right about your bias. However, you are too early to the party, the market knocks you out and it will trade higher again. So what do we wait for? To confirm that the market's not going to trade lower again, we wait for a change in the state of delivery. So we're waiting for the market to close above these up close candles. So what do? We trade higher and we have a close above these up close candles. Once we have a close above these up close candles, we can look for an entry on the M15 or the M5 chart, and we will target all of these highs. What are they? They are failure swings again. And what do failure swings have? They have liquidity. So after the 1 hour chart, we will move on to the 15-minute. So before any of this occurred, the market was low probability. And now you guys can see how the market structure is aligning and everything is becoming high probability now. Okay, on the M15 chart, you guys can see this is where we ran the low again that I was talking about, and we had the reversal. Once we had the reversal, we closed above these up close candles. Once we closed above them, we are looking at these fair value gaps for entry. And you guys can see we have a failure swing right here, and we have a failure swing right here. So this is the buy side liquidity that we are looking to target, and we have the daily fair value gap above us as well. So this is what your long position will look like. You will look to buy these fair value gaps. So when price trades lower, we'll trade into this gap, and we are looking for a retracement for price to trade higher. So the market can trade into this fair value gap, which is right here. This is why your stop loss will usually go at the candle's high, which create the fair value gap. So even if the market does dip lower, come into this fair value gap, we can trade higher again. So it gives you the peace of mind of knowing that you are inside of a position and you will target the buy side liquidity, which is right above us. So this is a 1 to 3 trade setup, and you guys can see we trade into the fair value gap, price trades higher, and we are just looking for the market to trade into the failure swings for a low hanging fruit target, and as well as the daily candles high, which is the range high. So as you guys can see, we trade into the buy side liquidity and the daily fair value gap. So let's see how this looks on the daily time frame. Okay, so this is what the range looked like. So as you guys can see, we failed to go above this candle's high, and once we traded below this candle's low, we left failure swing. So this is what we were looking to target, and you guys can see we trade higher and we trade into the daily fair value gap. And this is exactly what we went over. So if the market trades higher and we take out this candle's high, we can look to target the low. However, we didn't take out the high, we took out the low first, which made us believe that the market was going to trade higher, target the failure swings, and trade into the daily fair value gap. Before any of this happens, you guys are not trading when this candle prints or this candle prints or this candle prints. You are using this candle as a confirmation that the market is going to reverse. Once we have the confirmation and the change in the state of delivery, this is where you'll look to buy, and you will target the candle range high. So this concept is known as the inside day range. So where market fails to go above previous day high or previous day low, we stay inside of this candle's range. And this is where the seek and destroy profile will form, which will be inside of this range. Once we take out one side of the liquidity, order pairing will take place, and then order pairing will take place at the other side of the range. So I hope you guys found this video useful. I am going to be teaching my model on this concept soon on my YouTube channel. However, I'll be teaching it first inside of my Discord. So if you do want to join that, just leave a comment down below saying Discord, and I will send you guys an invite link. Other than that, I want to thank you guys for watching this video, and I hope you guys found it insightful. As always, thanks for watching.